Ladies and gentlemen, good day and welcome to the Q4 FY22 earnings conference call of Windlas Biotech Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Hitesh Windlas, Managing Director of Windlas Biotech Limited. Thank you, and over to you, sir.
Good evening, everyone. It's a pleasure to connect with all of you present on the call today. We have uploaded the press release and investor presentation on our website as well as on the exchanges. I hope everyone must have got an opportunity to look through it. Initially, I would like to discuss key company highlights for Q4 and FY22, followed by financial highlights of the company, which will be shared by our CFO, Ms. Concall. The company registered a consolidated adjusted revenue growth of 11% YOY in FY22 on the back of strong growth in domestic trade generics and exports verticals. For Q4 FY22, consolidated revenue, EBITDA and PAT grew by 14.3%, 28.7% and 150.8% respectively. The company reported this robust set of performance despite challenging business environment on account of continually rising input costs, supply chain disruptions from uncertain geopolitical situation. Our FY22 revenue for CDMO services and products vertical stood at 379.7 crores, up 4.9% YOY, which contributed approximately 81% to the consolidated revenue. The company continued to focus on growing revenue share from chronic and subchronic therapies in complex generic products, which are high growth segments of the market. Over the past year, we have reinforced our R&D capabilities and continued to do innovative product launches for our customers. Our R&D costs have grown at CAGR of 16% since FY19. The company expects to realize the benefits from these investments in the coming years. Company has also received GMP certificate from South African Health Products Regulatory Authority for the audit that it had undergone in September 2021. Apart from this, the company has successfully concluded EU GMP inspection by National Institute of Health and Nutrition, Hungary, for Plant 4 with 0 critical and 0 major observations. The company is expecting a positive outcome on the EU GMP in coming months. These positive outcomes by inspections from reputed regulatory authorities reflects our sustained efforts on improving quality systems and capability. Successful completion of these audits allows us to expand our geographic presence in 6 markets. FY22 revenue for trade generics vertical stood at 60.8 crores, up 39% YOY. The company continued to focus on delivering the existing stockist and distributor network along with additional new brand launches to drive this robust growth. Trade generics vertical contributed approximately 13% to the consolidated revenue. The company is focused on growing the trade generics business through channel, product, and geographic expansion. The growth will be further supported by government schemes that increase generic adoption and reliance on generics across India, such as Jan Aushadhi Yojana, Ayushman Bharat, etc. FY22 revenue for exports vertical stood at 20.9 crores, up 10.2% year-on-year, and export verticals contributed approximately 4% to our consolidated revenue. Initiatives for CDMO vertical like new patent expiry launches, increasing wallet share from existing customers, foray into injectables, and new customer addition is expected to drive the growth in CDMO. Growth in domestic trade generics vertical is expected to come through brand building, channel expansion, new product introduction, and geographic expansion. While for export, growth would come through new dossier filings and registration in existing and new markets. I will now request Ms. Komal Gupta, our CFO, to discuss the financial performance highlights.
Thank you, Hitesh. Good evening, everyone. Let me quickly take you through consolidated financial and operational highlights. For Q4 FY22, our consolidated revenue, EBITDA and PAT grew by 14.3%, 28.7% and 150.8% respectively to rupees 122.1 crore, 14.3 crore and 14.8 crore respectively. For FY22, consolidated revenue and PAT grew by 10.8% and 32% respectively to 465.9 crore and 38.1 crore respectively. The company's financial performance strongly reflects the company's execution capabilities, strict control on costs and resilience despite several challenges that impacted supply chain and input prices. EBITDA of the company remained largely stable on YoY basis despite sudden and sharp upward movement in input costs. The company successfully managed to maintain the gross margins above 35% mark. Higher R&D, product development costs, registration costs and product mix impacted the EBITDA margins to some extent. I will now take you through vertical-wise highlights. CDMO. Q4 and FY22 revenue for CDMO vertical stood at 96.9 crore and 379.7 crore, up 11.4% and 4.9% YoY respectively. CDMO vertical contributed approximately 79% and 81% for Q4 and FY22 respectively to the consolidated revenue. Trade generics vertical highlights. Q4 and FY22 revenue for trade generics vertical stood at rupees 14.7 crore and rupees 60.8 crore, up 30.7% and 39% YoY respectively. Trade generics vertical contributed approximately 12% and 13% for Q4 and FY22 respectively to the consolidated revenue. Exports vertical. Q4 and FY22 revenue for export vertical stood at rupees 9.5 crores and 20.9 crores, up 14.3% and 10.2% YoY respectively. Export vertical contributed approximately 8% and 4% for Q4 and FY22 respectively to the consolidated revenue. The company continued to be a net cash positive company. The company is utilizing cash judiciously for injectables CapEx while maintaining the strategic reserve for inorganic growth opportunities. Out of 152 crores raised in the IPO, the company has spent 71.6 crores on different objects outlined in the prospectus, corresponding to a usage rate of around 47.1%. That's all from my side. We can now begin the Q&A session. Thank you.
Thank you very much, ma'am. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Aditi Shavan from ATM Advisors. Please go ahead.
Yeah, hi. Thank you so much for the opportunity and congratulations on good set of numbers despite challenging environment. I have a couple of questions. First is in our CDMO vertical, total numbers of customers served in FY22 has increased by 40%, while the CDMO revenue grew only by 5%. So can you explain this gap? And can we assume these new customers are low revenue contribution customers? And also, can we expect the revenue growth to catch up the new customer addition growth rate?
Sure. Ms. Aditi, firstly, I would like to say that, as a CDMO, we are serving more than 200 customers, and it is always our desire to continue to fan out this customer base. And in fact, one of our health metrics is that we try to not have too much dependent on our largest customer. And we want to continue to serve a broader set of, customers across geography, across therapeutic categories, and so on. What we have seen is that, though our growth in CDMO has been on a year basis, fairly low at 4.5%, the number of customers that we have added has helped us, maintain diversity and also not come too much under pricing pressure. So our growth has come from new accounts where new launches have been done, and we are now looking to mine these accounts for further growth in the coming quarters and the coming years. So these new additions are a very rich source for increasing business for us in the coming period. Now, when we add a customer, usually the product range that we supply to them is smaller. The amount of risk that a customer is taking with us is lower, and so immediately the values per customer will not rise. But as we increase service levels, as we offer a wider range, as we engage more and more, we grow these accounts. So that is, in short, a way that we expect to sort of nucleate more accounts and then grow in them. And while I cannot comment in whether the growth rate of sales can catch up to the growth rate of customers, but this is a constant parallel activity, and we must continue doing this.
Okay, so thank you. That was helpful. Just correct me if I'm wrong. Like in our CDMO vertical, our contracts are priced as per cost plus model. So if that's the case, can you explain what has impacted our EBITDA margin?
Sure. So in our EBITDA margins, actually, we have done a lot of R&D expenditure and product development expenditure to the tune of 29 million higher than last year. And also product registration that we have done this year is 9 million higher than last year. So netted about 38 million from product registration or development, and 18 million of ESOP reserve that we have booked for this year. These are the factors that have mainly dragged the EBITDA margin a bit down, although not the operational, because this is more like an investment for us for future growth. But yeah, we have booked it in the expenses, and the picture looks like this. Having said that, in material margin also, there is reduction of 0.8% as compared to last year. But as we discussed in the last quarter also, the overall impact of global supply chain issues and product availability impacts us to some extent, and there is a lag between when we are able to get the increases from customer throughout.
Okay, ma'am. Got it. Just last question, like our exports revenue growth for H1 FY22 was negative, while we closed the whole year with 10% growth. So can you throw some light on what has gone well for us in H2, and can we expect the similar momentum for FY23 as well?
In H1, actually, we were facing a lot of supply chain issues at customs. So the goods were manufactured, but we were not able to ship them because of the issues, a few restrictions that were there either at the country's side or from our side to ship. So we were able to resolve those problems. Overall situation becoming better has resulted in a growth. So we should not look at probably at quarter numbers for growth. Your growth is what we should consider.
Okay, that was helpful. And that's it from my side. All the best for upcoming quarters.
Thank you.
Thank you. A reminder to the participants: anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Priyanka Shah from NN Securities. Please go ahead. Priyanka Shah, your line is in talk mode. Kindly go ahead with your question, please. Seems like we have lost the connection for the current participant. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Dipti Kotari from Kotari Securities. Please go ahead.
Thank you for the opportunity, sir. My first question is that our EBITDA
Kotari,
margin...
sorry to interrupt. If you can take the phone off speaker, please.
Yes. Thank you for the opportunity. My first question is our EBITDA margins for FY22 are around 11.5%. What kind of margins can we expect for FY23 and FY24? Also, what is the long-term target of EBITDA margin?
So for FY20, as we discussed for FY22, the margins have been impacted a bit. So we were hoping to bring in purchase efficiencies and end up at better material margins. But given all the supply chain issues that have been in place to meet the kind of growth that we have delivered, we had to actually let go of some bit of material margin. We would be in a better position to explain about what can we expect for 23 and 24. After a quarter, we are hoping that we are able to see more stability, and we would be in a better shape to then probably comment on this. In terms of long-term material margin and EBITDA margin levels, we expect 1 to 2% better than where we are at once stability is in place and we are able to get the operational efficiencies from our.
Yeah, see, in the long term, we expect to increase the proportion of our and export contribution, both of which are higher material margin businesses for us. Also, injectables, once fully, the injectable facility, once it comes up and fully utilized towards the end of our, 5-year period, will also be a much better, much higher EBITDA margin business. So, everything that we are doing to grow will help in improving margins, whether it is operating leverage, whether it is buying efficiency, whether it is increased proportion of higher profitability businesses. But yes, we will have to travel the path through that period of investing and then growing. And as you can see, we are investing through our P&L. So, we do that, R&D costs and the registration costs kind of have to be looked, at when in perspective when looking at margin. But yes, we are also looking to build improvement in margins, but we have to wait and see what happens to the global supply chain issues. As you know, that a lot of the input costs, materials, crude, hydrocarbons, solvents, fine chemicals, all of these are still in flux, and therefore probably we can revisit this question 1 quarter down the road.
IPM growth slowing down to the significant extent. In fact, significant growth in FY21 and FY22 came mostly due to COVID-19 related drugs. Can we expect our revenue growth to stagnate due to this?
So, as far as what we can share without revealing from a competitive perspective, last couple of quarters, hardly much shipment of COVID products have gone from our side. So we are, almost after the second wave, which happened in the April, May, June time frame, we have pretty much not been, shipping much of any COVID-related products like hand sanitizers or, all these things. anyways we were not participating in antibiotics. So that is where, last year, FY21 and FY22 especially, IPM saw a very big jump in antibiotic consumption during the second wave. We did not participate in that. So my sense is that at least those base effects are not built in. But yes, we still are looking to, the way we are focused on bringing new products is to stick to our core expertise in cardio-diabetic space, in urology space, and in these chronic disease spaces where there is a need of the market, and also our core capability is there to deliver.
Also, lastly, sir, on the cash on our balance sheet is close to rupees 114 crores, while our capex requirement over the next 2 to 3 years is rupees 50 crores. So can you share how are we planning to utilize this cash balance? And also, you had mentioned in the previous calls that the company is actively seeking inorganic growth opportunities. So any progress on that? Also, what kind of opportunities are we seeking for inorganic growth?
Firstly, just a kind of clarification, the liquidity that we have on our books is 180 crores as of today.
Yeah, 180.
Yeah, 180 crores. So, having said that, out of which about 50 crores, you are right, will be spent on capex, and there will be about 17 crores of working capital for which we will take out the money from IPO proceeds once there is increase in working capital. So 67 crores out of this will be used to that extent, and rest is obviously we are looking for the merger and acquisition opportunities on which Hitesh.
Yeah. So, as I spoke in the past also, we are continuing to evaluate, as various options come to us. We have looked at, a couple of options, but not found something that immediately we can jump on. But we are continuing to evaluate. And the criteria that we are looking for in terms of inorganic opportunities is very, very clear in our mind. The first is that it should be a growing business, and in the space that obviously we have some either a value chain play or a expansion kind of a play. And the second is that we are looking to not just look at something where what is the size and how cheaply can we buy, but we also have to see what can we do with that acquisition. What value can we add and what next level we can take that to. So this is a very deliberate discussion, and we have been evaluating, and I hope that in this coming year some further success will be obtained in terms of finding a good opportunity.
Okay, thank you so much, sir.
Yeah.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Akash Mehta from Capex Investment. Please go ahead.
Hello. Good afternoon. Good evening, sir. I had a couple of questions, one on the therapies and one on the Capex. So on the therapies front, what is the long-term aim for the contribution from chronic and subchronic therapies?
So currently, chronic and subchronic, we are in the range of 60 to 70%. Komal can give the exact number. But we feel that more and more of our new launches, especially, are in this space only. So as we see going forward, we expect this concentration to increase, and this is where the disease burden for India and the markets that we are operating in is also there. So we expect to increase this. What was the second question? I'm sorry.
So firstly, the ballpark contribution from these, and the second would be when do we expect the civil work of the injectables Capex to get over, and when do we expect the capacity to reach peak utilization level?
Right. For the injectable, our goal was to have the first commercial batch come out by end of this year. We have to see where, but we believe that at least there will be a 1.5 year period where there will be operating losses compared to capacity filling. So this is the gap that we have to bridge, and we are evaluating various options to try to see if we can get our own trade generics to carry some injectable portfolio, so which we can move in-house later on, and various other options. But what we see is that the full impact of injectables will be by FY25-26, where the utilization levels and contribution levels should reflect in our financials as a positive force.
So FY25-26 is it? Or?
I'm sorry, I couldn't hear your question again.
So you're saying FY25-26, we expect the peak capacity.
26 is when we expect even the third line to be put in, and the final year where we expect a significant contribution.
Okay. Just one last question. What is the peak revenue potential from these injectables, and what kind of margins can we expect from them?
So in the asset turnover ratio for injectable business is very different from oral solids. In our case, oral solids we are doing somewhere in the range of 4.5 to 5. But in injectables, we believe the asset turnover ratio will be more in the range of 1.25. So for this project, over a period, we will be spending approximately 70 crores, and I believe therefore the revenue potential from here could be in the range of 100 to 125 crores. And obviously it depends on product mix, markets we are shipping to, and so on. But from a margin perspective, we are expecting either somewhere around 18 to 19% kind of EBITDA. So this is our expectation.
18-19%. Okay. Okay, I think that's it from my side. Thanks a lot.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Riya Verma from Oracel Securities. Please go ahead.
Hi, sir. Thank you for this opportunity. I have 2 questions. Firstly, can you help us with gross margins for chronic, subchronic, and acute therapy? And secondly, how would our revenue contribution in terms of percentage would look like between CDMO, TGX, and exports 4 or 5 years down the line, once we are close to our 2x, 3x, and 4x targets of revenue growth to these verticals?
So I think obviously our desire is to increase the proportion of trade generics and exports. As you know, exports is a more fag-ended business where initially you invest in the registrations, and as these various registrations come in, then the revenue stacks up. So this is where we said that in 5 years from FY21, we will try to have a 4x kind of a size for exports vertical. In kind of from say for trade generics, this is where we said that we will expect to triple. My belief is that the opportunity in trade generics is actually greater, and so obviously we will be gunning for improving this further. And in the CDMO business, we have said that from FY21 in 5 years we will double that business. So the proportionate calculation.
So domestic should be somewhere in the range of 65 to 70 is our estimate. TGX somewhere 15 to 20. Exports about 10. And injectables, if we keep it separate, will be somewhere between 5 to 10%.
Yeah.
Okay.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Priyanka Shah from NN Securities. Please go ahead.
Thank you, sir, for the opportunity. So my first question is, as per your press release, the board has approved rupees 3.5 per share dividend. Will we continue to distribute excess cash to dividends?
Ma'am, we have a dividend policy where we have mentioned that as close to 20% of PAT as possible, we will continue to distribute. And only in cases where we see imminent use through something else are we going to not do that. My sense is going to be that we will try to maintain the discipline of distributing, and only in very rare cases will we look at not sharing the dividends at all. But my sense is that this is something that we want to make sure that we are able to provide predictability and provide comfort to our investor base that yes, we will do.
Okay, sir. So our R&D cost is just close to 1.4% of revenue for FY22, which seems to be on low side if we compare with other listed pharma companies. Is this the level we expect going forward as well?
So, ma'am, I think if you compare us to other listed pharma companies, then since they are investing heavily into international assets, ANDAs, supplies to US, Europe, and they are also doing new chemical entity research, that comparison may not be apples to apples. In our space, which is largely unlisted, we are the only listed player in formulations for CDMO for India. We believe that R&D should inch up. Over the 5 years, we expect it to go to about 2% of our top line. So slowly we will ramp, and that's how we think that it should follow through.
Okay, sir. Thank you so much.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Miten Latia from Fractal Capital Investment. Please go ahead.
Yeah, thanks for the opportunity. Just one question. If we were to look at Q4, should we say that the CDMO material margins had normalized at least towards the end of Q4? The Q4 as a whole, maybe not, but at least towards the end of Q4, we came back to normal material margins on the CDMO business?
Not yet, Miten. We expect the normalization to happen maybe in Q1 or Q2 down the line. The normalization has not yet happened. Overall, betterment in the improvement that we see in Q4 is mainly driven by TGX higher proportion in the quarter. Having said that, we are seeing the betterment in the margin, and we expect that to normalize soon.
There are two factors, Miten, that are at play. One is, the customers looking to get a bargain when they are not meeting their sort of the price increases that happened over the last year. For example, in metformin or in paracetamol, were not like small percentages. It went 2x, 3x of their initial prices. So to the large extent, we were able to transfer these increases to customers, but there is obviously a pressure on them to improve their margins. So there is that negotiation. And on the other side, the input price material price fluctuations, which were earlier led by China and Winter Olympics in China and so on and so forth, there are other global reasons like the crude going up and which are all input raw materials for fine chemicals, intermediates, and thereafter APIs. So some impact of this is yet to come, and it's probably anybody's guess in terms of timing. So that is why we feel that it's very hard to comment on what will be the near-term future. But we believe, yes, in the long term, we should be able to work at the margins that we have historically worked on.
Because both on customer addition as well as in the product diversification, we've done reasonably well on FY22 as a year. So that positive tailwind also should be visible on FY23. Is it fair to say, or this mining will take a bit of time?
No, so definitely our internal goals are to harvest the momentum that we've got, and we are more than keen. But as I mentioned in the past also, Miten, so from a quarter-to-quarter perspective, we're too small, as a company to look at from a quarter-to-quarter perspective as compared to the overall market. So our guess will be to look at a slightly longer horizon, and that's why I'm more confident of a long term. And it's very hard to say whether what happens to certain API prices tomorrow, and we continue to work to optimize. In fact, if you remember, coming into this year, we were expecting to improve margins, we were able to maintain more or less same material margins, but that's to some extent also because of our better performance on our trade generics, where obviously we have better margins. So sorry to not be able to give a clear, definite answer, but these are the factors which are playing behind the uncertainty.
Thanks, appreciate that a lot. I mean, I was not looking for a definitive answer, more a directional thing about how things were panning out on the ground. And I hear you that maybe it's, and I was also not looking for a quarterly sort of trend. I was more thinking about FY23 as a year. Should it be closer to normal or no? But I guess that's probably not so certain as of date.
Yeah. No. So these kind of margins where we are in FY22, we are confident to maintaining that. What we were talking about is how much we can sort of improve and
back to FY21 kind of margin.
Yeah. So that is where we struggle. When would that start? So we are not saying that this can go below in the long-term scenario. We are actually looking forward for the growth only. But obviously, quarter-to-quarter variation can happen. But as a year, we are estimating same or better.
And just one more slide. Anything you would like to call out on the trade generic side that would change the trajectory for FY23 and also on the export side, or is it business as usual on both?
No, Miten. I would stay conservative and say it's business as usual on both.
Wish you all the best, and thanks for your time. Thank you.
Thank
you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. As there are no further questions from the participant, I now hand the conference over to Mr. Hitesh Windlas for closing comments. Over to you, sir.
Thank you, everyone, for joining us on this call and giving us an opportunity to share our perspective with you. Please reach us through our IR consultants, strategic growth advisors, or directly should you have any further queries. We can now close the call. Thank you.
Thank you. Ladies and gentlemen, on behalf of Windlas Biotech Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect.